top three things in the macro notebook. First thing is the Swiss franc. Second thing is oil. Third thing is financial. So we've always said that the bubble in central banking would perpetuate the next crisis, and growing panic by the Swiss as they abandoned the euro peg this morning, and in doing so effectively abandoned their kind of ongoing effort to discourage inbound capital flows from Russia and elsewhere. They cut rates by another 50 basis points down to negative 75 basis points as an attempted offset, but it's really not going to help. So all this equates to really a massive margin call on levered FX trades, and Swiss equities are trading down pretty hard this morning. At last check, the currency was off around 14% and equities down around 10%. Moving over to oil, so if you follow the deflation dominoes there, currency wars, yens and euros burn, dollar goes up, things priced in dollars, i.e. oil, start to crash, spreads blow out in high-yield energy. That ultimately flows through to energy states, losing both jobs and money. Financials and industrials and broader late-cycle exposure starts to roll over, and the Fed ultimately pushes out hiking expectations. So that was the call we made in our 1Q themes call, and we'd be reiterating it alongside the news this morning. Third thing in the macro notebook is financials. So yesterday's drop in JP Morgan was the biggest since 2011, and that came on big volume. If you view 2011 as a good analog, last time this happened, so we had global growth slowing, expedited decline in rates, and big yield spread compression. In that instance, financials had its worst performance divergence versus utilities ever. So they've got the XLF down around 5% already year to date, and regional banks down over 10% versus the SPX high on December 29th.